Here, we're moving into a calculate the net profit of the business. This particular problem is extremely robust. Very, very, very robust. There's a lot of information here, and we're going to set a lot of information so that you understand the concept behind it and are ready to apply it. So we have a die-cast manufacturer. Is in the planning stages to develop a new product which will sell for $2 per unit. The manufacturing parameters are found in the table below. And so let's take a look at the description of each and the allocation that the company is making for this. And as you can see, the cost of the manufacturing equipment is $200,000. However, there's this thing called a salvage value for the manufacturing equipment, which is $10,000. We have the economic life of the equipment, so it'll be available for production for 10 years. The number of units the equipment can manufacture is 1 million. Now we have our cost, our direct labor cost. This is what it costs to make the unit. Here is our direct material cost. This is what it makes. It takes 65 cents to make it, 30 cents a unit for the labor. Then we have variable administrative and selling expense. That's got to be accumulated, and that costs 20 cents. So you have a marketing department, let's say, and you have to pay your administrators and all the rest, and so you have that overhead part of it. And our final one is the fixed overhead cost per year, not including depreciation. So we have $150,000 is your fixed overhead cost. That's what your factory is costing you, $150,000 every year. You can't run away from it. It'll produce whatever you put through it, and as a result, we're ready to move through this. So we also have some additional information provided for us in this little table here. And the problem goes on to say, if the demand follows the projected probability distribution shown in the table and straight line depreciation is used, the expected average net profit per year before taxes is most nearly. So this is our assignment. We take a look at all the parts for this, and now we're ready to start our analysis and go through the steps. Okay, so let's take a look. There's a question here, so we're ready to answer some of the concepts that we have here, okay? So let's take a look at what we have here, and that would be one of our first steps in determining what is the manufacturing equipment and what is the salvage value. And so we have $200,000. This is very typical, and we'll be reviewing this quite often until the end of the class of what salvage value is and how to apply it in the varying engineering economic analysis. So we have a piece of equipment that costs us $200,000. And at the end of time, at the end of 10 years, okay, we're finished with the piece of equipment and it's no longer going to be used. So let's say we call a scrap vendor up and they say, well, I'll give you $10,000 for that piece of equipment. Okay, that's for the scrap value, let's say. You can either call it a salvage value or a scrap value, or call it resale. You can sell it. Okay, we can resale, so we can sell it also. Okay, so we're going to get $10,000 at the end of 10 years. So your answer to how much does it really cost you and on your accounting books? Well, it's really cost you $190,000. Okay, so let's take this concept and further it, right? Let's further it and personalize it. Okay, this is the best way for you to remember what salvage value means, and you can always apply it, and I'll be repeating this quite often till the end.